Now, Tim, we want to turn to private markets, a part of the, I guess, investing ecosystem that a lot of advisors and fundies on this show particularly have come in and spoken about how they're now taking a larger portion of, position sizing in portfolios and the like. You, on the other hand, you've written that private markets aren't superior to their listed counterparts and that it is an illusion created by how they're valued.
This is the danger of writing things that can be quoted back to you.
We appreciate it researching because you've written a lot. So there was a lot of information on all of this. It's a pretty bold statement given, I guess, where the industry momentum is at the moment. So just let's start high level. Walk us through why you believe this is the case.
Okay, well, if we start from the beginning, the starting point for any comparison of assets is the return that gets delivered from that asset, right? Now, it didn't take long for someone to come along and say, well, that's not fair. You shouldn't compare an equity return to a government bond return. If they both deliver 6%, surely the 6% delivered by a government bond was much lower risk than the 6% delivered by the equity market. And that was self-explanatory, and so people started to think about risk-adjusted returns. But of course, we can't measure risk, and so we needed a proxy for risk. And the proxy that has been settled upon is volatility, right? Volatility of returns or volatility of price, right? But of course, volatility is not risk. And to make that really simple case, you can have identical real estate assets, right? One that's listed on the market and one that sits in a superannuation portfolio and gets marked at director vals or external vals every 6 or 12 months. And clearly the exact same set of assets will have different volatility measures. One's in the public domain where it's traded actively from 10 o'clock to 4:10 every business day of the year by a whole group of investors with varying degrees of knowledge and sophistication, and the other is marked by professionals once every 3 to 6 months or occasionally every year, right? So if two groups of identical assets can have very different volatility characteristics, then clearly volatility is not risk. But of course, once that assumption was made, off that was spawned a whole bunch of different ratios and metrics that people analyse because they think it gives them a fuller picture of a particular investment. So we've got Sharpe ratios and Sortino ratios and information ratios and tracking errors and everything else all spawned off the price volatility of a particular asset. Well, of course, there's lots of super smart people in finance. And so the smart people in finance realised, well, to get better risk-adjusted returns, we can actually change that equation so that it's in our favour, right? And the first thing you want to do is you want to take it off being marked 1,000 times a day from 10 o'clock to 4:10, right? And so you remove the number of data points because definitionally, if you remove the number of data points, you're going to have less volatility, right? And then the second thing they do is they say, well, let's take away all of the less sophisticated players. Let's not let mums and dads mark that asset. Let's not let fund managers mark that. We're just going to mark it based on an independent external valuation that's done every so often, right? And so all of a sudden, these assets that are in the private sphere with similar or even worse return characteristics to their public equivalents, on a risk-adjusted basis, so take the return and divide it by the standard deviation, they suddenly appear a whole lot better, right? And we saw great examples of this through the COVID period. You know, take the largest, we talked about it already, the largest automotive group in the country is Eagers. They have about a 14% market share. They dwarf the number 2 player, which is down in the low single digits, right? And a number of private equity houses own dealership groups that are, sub 2% in market share. Well, Eagers' stock price during COVID fell 70% peak to trough. And obviously then on the rebound, you get the volatility in both directions because volatility is just price change. And that contrasted with some of the markings that we saw in private equity portfolios for much smaller, much less sophisticated, much less capitalized businesses that were sort of orders of magnitude smaller. I'm talking 5 to 10% from peak to trough at the director vals, right? Now, clearly Eagers is not an inferior business. It's not a riskier business than those other businesses. But that's the problem when you take a concept in finance and then manipulate it in a way that produces superior outcomes for the purpose that you're trying to achieve, which is let's move more capital out of the public market and into the private market, ignoring obviously all of the detrimental side effects of doing that. And the most obvious of those being, a lack of liquidity, which we're starting to see in private markets now.